I've been on TikTok for about 3 years now, and the most popular question I get asked by like a mile is now the right time to start investing? I want to buy stock in this company, but what if it goes down? Should I wait? Should I buy now? Tell me what to do. When's the right time to buy? So there's a couple different options here. As you can see in this video, we're going to break them down. There are 3 options in this video, and I'll tell you what I do as well. And it also really depends on what the overall markets are doing too. If we're in a really strong bull market where stocks are just surging to new highs, new highs, new highs, and you believe in the company, you've done your fundamental analysis, and it's a company you really want to invest in for a very long time, then you might find that your best option in a very strong bull market is to go all in now. Your alternative would be to buy a little and then buy more at a higher price, which is also an option, right? We're very familiar with buy low, sell high. There's also another option, which is buy high, sell higher. Ride that momentum, chase that wave, get in on something that's moving. It really depends on what the overall markets are doing. Since we are in the year 2023 and markets have been very choppy, we've been in a kind of downward market over the last couple of years, this video is going to be more focused on what to do in bear markets when things are dropping. So let's just say we have a hypothetical stock that is $115 a share and you would like to buy 100 shares. It's going to cost you $11,500 to do that. Now you've got a couple different options here, but in your mind, you've done your research. You know this is a stock that's going to be $200 a share within the next couple of years, especially if markets can turn around, things recover as they often do, and the stock could go higher. If you were to buy it right now at 115, costs you $11,500, and you plan on selling it when it hits $200 to lock in your gain, it would be around a 75% gain, and your profit would be around $8,500, assuming you buy it at the right price and sell it at the right price, blah, blah, blah. But then you open an app like TikTok on your phone, and all the comments in every video talking about this hypothetical stock say, why would you buy it now? It's already down 50, 60% over the last couple of years, and it's gonna go lower. In fact, a lot of people, who are these people, doesn't really matter. They're just people, are saying, hey, it's 115 now, but this stock is dropping to 90, which means that from its current price at $115, it could lose another 20% and drop even lower. What do? You get like paralysis. You aren't sure what to do. You want to buy it, you believe it's going to go up, but everyone's telling you it's going to go lower. Should you wait or should you buy all in? So let's go over the options. Option number 1 is you wait. You try to time the market. You are going to wait for that stock to go from 115 to 90. And you're going to be risking the potential possibility that it doesn't. And that in fact, 115 is the all-time low, and the stock is going to start to climb higher from there. Anything is possible in the stock market. Nobody has a crystal ball, right? So the people who say, oh, well, it's going to 90, man, if it hits 90, they're going to come out and they're going to sell you a course or one-on-ones or a Discord private access, and they're going to say, I called it, I predicted, I knew. And then the other people who say, oh, well, 115 is the bottom, if they call it correctly and the stock rockets to like 150 after that, they're going to say, I timed it perfectly, I knew. And oftentimes what ends up happening is people listen to one guy on the internet saying, oh, it's going to 90, and they miss out on the opportunity to buy. So let's just run through this very unlikely scenario here that the stock, which in this hypothetical is already down 50, 60%, continues to drop another 90%. It's possible. Anything is possible. Are you willing to risk it, though, that you could be wrong? In this example, we're waiting. The stock actually, by some miracle, hits 90 perfectly, and you buy your full 100 share position right then and there. Now, in this scenario, the stock is going to go up over time. Right? I'm not going to go over what happens if the stock starts to drop another 20% from there. Let's just say in this hypothetical, you purchase it at 90. 90 is the 52-week low or all-time low, and the stock just starts to fly after that. They have good earnings. They have good forecast guidance, future guidance, and the stock starts to move. You've purchased your 100 shares at 90. It costs you $9,000. And then the stock starts to move up higher and higher and higher until a year or two later, it is now $200 a share. And it's time for you to say, you know what? I've got a nice big fat profit. I'm out. You sell, you make 122% on your investment or $11,000. This is by far the biggest percentage-wise and dollar-wise gain on your 100-share investment, but it might not happen. Are you willing to risk it? So let's go through the options, the other options. Option number 2, you buy all in right now. You say it's 115. I don't care if it drops another 20%. I believe in this company. I don't want to take chances. I just want in, and then I'm going to buy it and forget that I own it, and we'll check back in a year or two. You buy your 100 shares. It costs you $11,500, and the stock does drop, but it doesn't hit 90, but it gets close, right? It drops to like $95. But you don't have any more money because you went all in. You bought the whole position. So now you're looking at it 95 going, oh man, I wish I had another couple thousand to drop in the stock to average down, get a lower price point, but you don't. It is what it is. 2 years go by, the stock is $200 a share, and you sell. You lock in a 75% gain or an $8,500 profit. So not as good as $11,000, but you didn't want to wait. You didn't want to take chances. You wanted to go all in. Option number 3, this is what I do. And in this scenario, we're going half and half. But the other option, of course, if I had more room on the whiteboard, would be to buy in blocks of 25, which is typically what I do. Sometimes I do 50-50. You buy half the position right now at 115. It costs you $57.50. So just under $6,000. The stock drops to 90. Now you have your reserve capital that you can deploy and buy another 50 shares at your $90 target price. The benefit of this is that you have some skin in the game. That way, if you buy your 50 shares at 115 and it rockets and it does hit 200, you're not feeling bad. You're not sitting there going, damn it, I was waiting for it to get to 90. This is why I don't like that timing the market method. Because if you're wrong and the stock moves higher from the target, from the goal price, the current price of 115, you've missed your chance. You didn't get in because you were waiting for it to get to 90. The half and half method or quarter at a time method allows you to have some skin in the game. So when the stock doesn't go lower, you don't regret missing out. You've got some shares. You've got 50. So it's not 100. You don't have the full position, but you've got something. Now let's say you're wrong and it doesn't reverse course, it drops lower. Now you have the benefit of having extra money. You have more money in reserve that you can go and deploy to buy another 50 shares. So you can average down and get an average price. So let's go over it. The stock drops to 90 and you're going to deploy $4,500 more to buy 50 more shares. Now you have 100 shares in total, but your investment price, your total investment price was $10,250 because you got your other 50 shares at a much lower price point. So if you do the little math here, it turns out that your average price is $102.50 per share because you bought some at 115, some at 90, average is $102.50. Now again, in this scenario, the stock flies, it hits $200 a share in 2 years, you make $9,750 or a 95% gain. This is the method I prefer. I don't like rolling the dice that it's going to go lower and then I miss out and it goes higher and I never got a chance to get in the first place. I also don't like buying all in right now because I don't get the opportunity to average down if it does drop. Option 3 is great because, like I said, it gives you skin in the game, but it also gives you the opportunity of holding off some capital in case the stock does drop lower. That's how I invest, especially in bear markets. In bull markets, it's a totally different story. But when things are going down, earnings very volatile, the global economic climate is very volatile, I don't want to tie up all my money. That's how I do it. Let me know in the comments what you do, if you do something similar, if you do something different. I'd love to hear it. If you thought this video was helpful, hit all the buttons, subscribe, follow. Thanks for watching, and have a good day.